Welcome to Five Good Questions. I'm your host, Jake Taylor. Our guest today is James Grant. Jim is a financial journalist, historian, and the founder and editor of Grant's Interest Rate Observer, a twice-monthly journal on the investment markets. After receiving a BA in economics from Indiana University and a master's from Columbia in international affairs, Jim became a reporter at both the Baltimore Sun and Barron's. He's the author of numerous books. His newest, The Forgotten Depression, 1921, The Crash That Cured Itself. It's a history of the last time that the U.S. government declined to interfere in the business cycle. Let's ask him 5 good questions. Hi, everybody. Our guest today is James Grant, author of The Forgotten Depression. Jim, I really appreciate you coming on the show today.
Jake, it is my pleasure. Nice to be here.
I have to admit that I'm actually a bit of a Jim Grant fanboy. It's very rare to find somebody that appreciates both Ben Graham and von Mises, so it's kind of my special honor today.
Well, I thank you so much.
Jim, you ready for 5 good questions?
I am. Shoot, Jake.
All right, number 1. So your book is basically about this era in history in 1921 in the U.S. where we had a depression and the government basically was hands off and didn't take a whole lot of action. Could you kind of walk us through like the Cliff Notes version of what was going on in the world leading up to 1921, and then kind of what was the general economic world look like then?
Yeah, I'd be happy to. Of course, what causes a depression is in good part the preceding boom, and there was a boom coming out of the First World War. The wartime necessarily is a time of, almost always is a time of inflationary finance. World War I was no exception. Treasury borrowed a lot of money. The Fed financed that money at very low rates. It was a great boom in lending and borrowing with the predictable inflationary consequences. Now, for most of history, the aftermath of most major wars has been deflationary. And people expected an immediate deflation come the armistice in 1918, but Mr. Market confounded those expectations, and prices, instead of falling, continued to levitate. Now, as you know, Jake, prices in a market economy are traffic signals. They direct investment and effort, and prices, as they kept rising, induced entrepreneurs and wage earners and farmers to do more of what they had been doing, which is to say, overdo what they had been doing. So General Motors built a great big, headquarters building in a haberdasher in Kansas City, Missouri, named Harry S. Truman, opened up shop thinking there were not enough places in Kansas City to buy suits and neckties. Farmers planted fence post to fence post, and so that was a setup. The world was at peace, but it was not a happy place. An influenza pandemic was even more lethal than the First World War. But the world picked itself up and got down to business and expected boom times. But the world was disappointed. About the spring of 1920, prices broadly, worldwide, began a great plunge. Never before had prices fallen so far in such a short period of time. All commodity prices on average were down about 40.5% before the deflation ended about 8 or 9 months later. Stock prices were down 45% or thereabouts. Industrial production collapsed. Unemployment went sharply higher. What to do? Well, what the government did was principally nothing. It balanced the budget, and the newly formed, still wet behind the ears Federal Reserve actually raised interest rates rather than lower them. So, Jake, the question before the House is, why did this depression ever end? It was met, after all, by policies that both monetarists and Keynesians today would characterize as medieval. Yet, 18 months after its official beginning, the depression bottomed out, and there ensued the proverbially roaring 20s.
And so, what was the Fed's action at the time as all of these deflationary happenings were going on? I mean, in today's day, we would expect them they'd be printing money like crazy, lowering interest rates. What did they do then that was so different?
Well, they did exactly the opposite. The Fed then was under constraint of the post-World War One gold standard, not nearly so well-shaped or rigorous as its classical predecessor, which ended in 1914, but still there was that constraint on the Fed's actions. More than that, there was the constraint the Fed imposed upon itself. It believed that the price level had been disastrously inflated through wartime finance, and it meant to be the agent of the restoration of normalized prices and wages. And Benjamin Strong, who was effectively the head of the Federal Reserve System, but nominally merely the president of the New York Federal Reserve Bank, confided in letters that he was all for deflation. He meant it not as an inhumane or as a cruel thing, but rather as a constructive thing, after which he thought, after prices normalized, America would be off to the races with an almost, as he said, impregnable banking situation. So that was the Fed then, as you note, a very different animal.
Yeah. Well, and like they actually believed that liquidation was a necessary evil, that you had to take your medicine and then you could move on.
They did indeed, and to that end, they raised interest rates in the face of collapsing commodity prices. And we can't really appreciate just how violent was this collapse, but it took away the breath of people who had seen the depressions of the 1890s and even some graybeards who had been around in the 1870s. The world had not seen anything quite like this. It began in Japan with a silk market, and it rolled its way around the world. And in America, it was a sight to behold, a very frightening one. And in the face of these collapsing prices, the Fed raised, mind you, its discount rate to 6, 7, I think at 1.8%. When set alongside a rate of collapse about 40% per annum in prices, these real interest rates, inflation-adjusted interest rates, were strangulating, very, very constricting.
Yeah, but then you had wages to fall along with it, so that businesses could be profitable again, and then get back
well, that to me is the key difference between our last governmentally unmedicated business cycle downturn and cycles that followed, is that wages did fall, not quite so fast, by no means so fast actually as the collapse in commodity prices, but wages did fall, and in falling they helped to synchronize costs and profit margins again, so that the upturn would be profitable.
Right. Yeah, which is what you needed to get back to a healthy footing. So let's jump to question number 2. And
that was question number 1. My goodness.
Yeah, that was just question number 1.
Okay.
Yeah, they don't all have to be as long as that. If you're, this kind of speaks to, it's along the same lines, but during 2008, George Bush was quoted as saying, "If money doesn't loosen up, this sucker's going down." And Warren Buffett talked about it as if it was an economic Pearl Harbor. I think one of the issues that we have today is that economics suffers from physics envy, like a hard science. And they'd like to think that they have more control over this machine than I think maybe is what actually possible. What do you think? Do you think that this 1921 data point is scientific enough to provide a almost like a control group in a scientific experiment of what would have happened in 2008 had we not intervened as much as we did?
I think not. There's nothing like scientific precision, of course, in historical analogy. It is only an analogy. And of course, needless to say, so much is different today. America is massively bigger in its productive power and in its wealth and in the complexity of its financial arrangements, and of course, in the structure of its financial government. The Federal Reserve today is kind of, it's all intrusive. People expect it to be all intrusive. Wages are meant never to fall. Prices ditto. The Federal Reserve wants them only to rise, so we can't exactly superimpose events of a distant era. However, Jake, in 2008, the 1930s was the episode that monopolized the market in historical analogy. People only harked back to the 30s. And they said, unless we do this and that, we will suffer the Great Depression again. Well, 1920 and 21 is not a scientific data point, but it is a suggestive observation on the resiliency of markets and on the behavior of people in markets. And I think for that reason alone, it is very useful. It's not going to prove anything. We can't prove a counterfactual. We can't, of course, imagine what things would be like as if 1921, with all of its institutional arrangements, were brought forward to the present day. But we can observe that with unchecked market action, with the free play of the price mechanism, that bad things happen, but those bad things happened expeditiously. And that what followed the closing of that cycle of bad things was many years of growth and invention and enterprise and prosperity. So I don't expect anyone to use 1920, 21 as a precise template for future action, but I would hope that this era of our history enters the conversation and makes a mark on the supposed students of the 30s, such as Ben Esperanti, PhD, who could for once pay attention to something outside his immediate field of vision.
Yeah. Our question number 3 is kind of more of a thought experiment, but I think, given your background and your historical research, I think it'd be interesting to hear about your thoughts on this. I've often wondered what the world would look like if we actually had all of the deflation in prices that all the technology that we've had over the last 100 years would have been reflected. So what I mean by that is, like the cost of producing things keeps dropping as technology makes us more efficient. Computer prices drop in half every 18 to 24 months, according to Moore's law. Yet, if you look back from like 1913 today, we've lost like 93, 94, 95% of our purchasing power of a dollar. So what would the world look like if we had a stable money system as opposed to an attempt at stable, and I'm putting that in quotes, stable prices, of 2 to 3% upward drifting inflation all the time?
Well, we can look back to the final quarter of the 19th century, which is a time of great technological progress and innovation and kind of scary discontinuities in the way people did their work. And people were displaced, they were disrupted, they were alarmed at the new things. But there was no Federal Reserve to insist that money be created such that the natural decline or dwindling in average prices would be reversed through monetary means. So according to Friedman and Schwartz, I think prices fell over the final quarter of the 19th century by about 1.5% or 2% a year, which was a great boon at the time to those not in debt. Real wages rose, they didn't fall. And of course, the fruits of enterprise and of invention were widely distributed. So that's one observation. We can also look at the 1920s, another time of very rapid progress in productive technique. By the 20s, the central bankers had come around to believing the Irving Fisher view that stability ought to be imposed through monetary policy, that we ought not to suffer either a rising or a falling level of prices. And the central bankers attempted to bring this stability about by purchasing government securities, what we call open market operations. And sure enough, during the 1920s, the price level remained largely unchanged. But a very interesting and I think persuasive school of thought holds that it was the artificial suspense of the price level that was in good part responsible for the disruptions that followed in the 1930s. So I'm all for everyday low and lower prices. It works for Walmart. It works for Silicon Valley. And I think that the drumbeat we hear from the central bankers about the perils of deflation is a theory with very little evidence and with a great deal of harm built into it.
Yeah, I think that's everybody's out space, especially in the mainstream, is brainwashed into, oh, deflation is bad. You must avoid deflation at all costs.
Well, they don't define it, Jake. I mean, what is deflation? One must distinguish, of course, between prices that fall because of a debt crisis, and during a debt crisis, people in needing funds must sell something to raise those funds so they can't borrow. And forced selling during a debt predicament is what I call deflation. That it's not a wholesome event. It's recurrent, but it's not what we want. But prices that fall on account of the improvement of the species, on account of improvement in technology and like, wouldn't we call that progress? I mean, the central bankers never distinguish between deflation and progress, and I think that distinction is critical.
Yeah, exactly. That's the whole point of technology, right?
You'd think.
Yeah. All right, let's jump to question number 4, and this question goes towards the view of the economy that I think a lot of people more in the maybe Austrian camp have, that, and I'm actually borrowing this phrase from Nassim Taleb, that the economy is more like a cat than it is like a washing machine. So we have this, and the idea behind that is that, it's more like a complex adaptive system like Mother Nature that is very hard to predict and is nonlinear, versus the idea that we can tinker with, interest rates, and that it's this math problem to be solved by some academic bureaucrat. What are your thoughts on that? Like, where do you come down on that? Do you think that we should have totally free market interest rates, or do you think that the Fed could, had it actually tried to keep a stable money supply, not necessarily stable prices, but like maybe could they smooth out a little bit of the fluctuations by stepping on the gas a little bit in like a downturn, but also, which we haven't had in 80, 90 years, raising interest rates in the event of when there seems like there's over speculation. What do you think about that?
Well, it's a very big question. Question number 4.
Yeah, it's not a small question.
As to the nature of the economy, it's interesting that in 1920 and 21, the very concept of the economy had not been invented. People talked about enterprise, they talked about bad times, good times, they talked about depression, they talked about booms. The word macroeconomy was not current, nor were there data to support a top-down view of the economy in all its complexity. And I do sympathize. In fact, I kind of relish that, the constructive ignorance of that day with regard to what we in our conceit call the economy. The economy is a cat, it's a Labrador retriever, it's something, but it's living. It's a kind of a human being, and it's responsive to incentives and to stimuli, and it's going to surprise you. Think how often the stock market surprises even the most knowledgeable and talented practitioners. It's because it's a human organism. So I take as my model of macroeconomic management Hong Kong under a man named Copperthwaite, who was the Secretary of Finance of Hong Kong in 1961 through 71, I think. And Mr. Copperthwaite, later I think Sir John Copperthwaite, ruled that he wanted no data collected lest some bureaucrat attempt to use those figures to manage what was a perfectly functioning free market enterprise. So I sometimes wonder, Jake, whether we aren't, all of us, kind of under the spell of a kind of a statistical hypochondria. We are confronted every day with a new battery of emissions from the government statistics mill. to be sure, many of them subject to significant revision. But our policymakers are data dependent. I mean, I think we need fewer data and more thought. So that did not answer question number 4, nor am I capable of it.
That's
Under
yeah.
5.
So, okay. Number 5. Okay, and there was much talk about too big to fail as this concept. What were there systemically risky banks back in the 1920 21 time frame, and if so, what happened to those banks? Because clearly there was bad loans made and they were insolvent institutions. What happened to those without a government to come in and bail them out? How did we fix that?
Yeah, well, good question. In the first place, the experience of the American banking business in 1920-21 was quite good. Banks did fail, but not so many, and they were almost invariably small farm banks without diversification of assets or of deposits. So the big city banks came through it. Now, some of these big city banks were in trouble. Today's accident-prone Citibank had its predecessor, National City Bank, at the time, and the ancestor to today's Citi was apparently also accident-prone. It was heavily overextended in Cuba against the price of sugar, which price really collapsed. The Guaranty Trust Company, which later was absorbed into the Morgan Bank and still later into J.P. Morgan Chase, was in difficulties. And these banks got through it. There were private rescue and liquidity injections. The Federal Reserve lent against good collateral. What was, I think, instructively different about the concept of banking safety then was that the stockholders of a nationally chartered bank were themselves responsible for the solvency of the institution in which they held a fractional interest. And if that institution became impaired or insolvent, they got a capital call. They had to stump up more equity under the terms of their investments.
Skin in the game.
Yeah, well, yes. And I mean, they got the dividends, right, when the going was good. Why shouldn't they be responsible if the management whom they elected made mistakes such that imperiled the bank? So I like that a lot. I like the double liability feature of American banking, which disappeared in the banking reforms of 1935. But that was the big difference. Leveraged financial institutions can fail. They are, if poorly managed, they are all too likely to fail. So there's always going to be some trouble. But what was different about the era before the 1930s was the personal responsibility of the owners of these banks in the solvency of the institutions in which they were investing. Very wholesome, in my opinion.
Yeah, no, I think that we could all agree that that you're going to pay a little bit more attention to your underwriting standards if it's your own money on the line, and instead you're not just only getting the bonus if it works out, and then taxpayers hold the bag if it doesn't.
A couple of years ago, I tried to publicize an idea of my friend Paul Isaac, who said there ought to be so we were probably not going to go back to a stockholder double liability for bank stockholders, but why not a clawback provision for bonuses and for compensation if the bank fails? And some of that I think has gained some traction. But certainly the idea of ownership, of owning, not only taking risk, but also bearing risk. Bankers took risk in 2005 and 6. They didn't bear that risk.
Yeah, huge difference. Well, Jim, that's all the time that we have today. I really appreciate you coming on and sharing your insights with us.
Well, it was a pleasure, Jake. Thank you.
And we got your book right here, The Forgotten Depression.
The merchandise. Excellent.
Yeah. Pick this up if you want to hear a different viewpoint of the same old, 1930 Great Depression is the only thing that we have to go off of, and too big to fail. And also just some great historical anecdotes. I learned a ton of things that about that time period that I didn't know. So, Jim, thank you very much.
You're welcome, Jake. So long.
All right.